Hello, everyone, and welcome to the October session of Markets Monthly Strategies and Perspectives. My name is Tom Bittinger, and I'm with the content team here at Wealth Enhancement. And before we begin, I just want to cover a few quick housekeeping items. As always, the session will be recorded. So if you have to step out for a second, or if you miss something, no worries. We'll send the recording to your inbox within the next couple days. And then also there will be a Q&A session at the end of the presentation. So use the questions pane on the side of your GoToWebinar menu and submit as many as you want, and we'll try to get to as many as we can at the end. So since we do have a lot to cover, let's just jump right into it. Joining us as always is Jim Cahn, Chair of the Investment Committee. Jim, I'm going to let you take it from here.
Thanks, Tom, and thanks everyone for joining us. It's been a very eventful quarter, and I think that there are a lot of anxiety going into year end. And so I'm here with our roundtable of specialists on the investment side to talk a little bit about sort of what's happened and where we might be going. Joining us today is Doug Huber, our Deputy Chief Investment Officer, Gary Quinzel, our Vice President of Portfolio Consulting, and Aya Yoshioka, our Portfolio Consulting Director. And I know they all have very interesting perspectives to share with you, our clients and our viewers. Before we jump into sort of the broader insights, I just want to sort of kind of remind everyone what's been happening, because when I talk to clients, there's a lot of anxiety out there. There are a lot of people that feel as if the markets are very precarious, that the economy is very weak. There's a lot of hangover, I would say, from some of the feelings around the pandemic and the decline in economic activity. When we actually look at the economy and we actually look at markets, the economy is doing reasonably well, right? Inflation has been tamed to the point where the Fed felt comfortable cutting interest rates by 50 basis points in September. And on the back of that 50 basis point rate cut, we actually saw equities rally to highs that we haven't seen. And so while it feels like there's a lot of anxiety in the marketplace, and I know a lot of our clients are feeling that anxiety, the markets are actually telling us things are doing fairly well. The employment situation is telling us that things are doing very well. And the great nemesis to both of these, which could be inflation, is actually starting to moderate quite strongly. The key questions that we need to talk about are, will we have this soft landing? It looks like we're going to have this soft landing that everyone's been talking about, which effectively is a slowing level of inflation without entering into a recession, which is basically two quarters in a row of economic declines in GDP, along with a lot of unemployment and the pains that come along with higher levels of unemployment. When will the Federal Reserve cut rates, right? It's very likely that if we have that soft landing, or unfortunately even a hard landing, right, that the Federal Reserve will cut interest rates further. And what's going to happen with the elections? I know that that's on everyone's mind. How will the elections impact the market? What should we be thinking about? How should we be positioning portfolios in event of one candidate winning or the other candidate winning? And so with that, I'm going to turn it over to Doug, who's going to give us a little bit of an update on what's going on in markets.
Yeah, thanks, Jim. And I think you bring up such an interesting dichotomy between this concept of what feels to be anxiety around the economy and markets, but the markets are kind of telling us something totally different, or at least did in Q3 and in September itself. I mean, obviously we did see a jump up in volatility in the third quarter. It started in August for some technical reasons, but certainly carried through September as the Fed was getting close to rate cuts. That being said, it was a good quarter for U.S. equities. If you're looking at the S&P 500, the S&P itself rallied 5.9% for the quarter. And I think what's really interesting is this is actually the first quarter since Q4 2022, that the S&P itself outperformed the Mag 7, those 7 high growth tech stocks that have been the talk of the markets for so long. This was actually the first time that the broader index outperformed those 7 stocks, which were up 5.4% for the quarter. That being said, growth as a style outperformed value still, and as a bit of a change, small cap actually outperformed large cap for the first time in some time. So it's interesting to see the markets are telling us, hey, the economy looks good. They were looking forward to this rate cut, and as such, equities did rally, albeit with some more volatility. I think U.S. has continued to be the leader here versus international. International was broadly up for the quarter and up in September, But Europe was actually a relative detractor. There's been weakness in the manufacturing sector and their growth outlook in general, as well as kind of some election activity in various countries in Europe has dampened their growth prospects, and I think the market's recognizing that. The other area of weakness early in the quarter was EM, although we saw a rally in September, and you can see that was primarily driven by actions in China. And I know we actually have a section on that, so I'm not going to dive too deep into that. But I do think that there were some interesting things that have gone on there, and that's really what spurred the rally in September for EM equities. And so actually with that, I'm going to pass it over to Aya to talk a little bit more about kind of valuations in the equity markets, because I think that has a lot to do with some of the anxiety we're hearing despite the markets continuing to rally.
Yeah, thanks, Doug. As Jim and Doug talked about, what's not to like about this market, right? We've got the economy doing well, labor markets are okay, inflation's coming down. We're seeing, solid returns in markets. And so when I'm asked what are we most worried about, valuations always tends to come to mind. So valuations here, as you can see in this chart, this is the valuation of the S&P 500, and you can see across multiple metrics. It's not just the PE ratio, but across multiple metrics, the S&P 500 is expensive. It's certainly not cheap. And valuation is a tough timing tool to utilize for short-term market timing. But we can say that, going forward, are the returns going to be as good as they have been in the last decade? That's a debate that I think Wall Street is really wrestling with right now. Goldman Sachs came out saying that the next 10 years is only going to have 3% type returns, whereas JP Morgan was a little bit more optimistic and talked about 6.5% returns, which is more along the lines of what we've seen in the past. So that's still yet to be reality, but we'll continue to debate it going forward. And then I will say, just back to Doug's point, we did see a broadening out of markets this past quarter, and we did see, the top 10 in the S&P 500 do carry a even higher multiple, right? They're closer to 30 times, but the other 490 are still at 18 times, which is still historically a little bit higher than the average 16.5 that is typical over the last 30 years, but it is elevated. And then when you look at other equity markets, whether it's small cap or the MSCI All Country World Index, excluding the US, we're looking at valuations that are a lot closer to historical averages. And so, having a diversified portfolio is something that we continue to advocate for. I'm going to hand it over to Gary.
I think what I would just chime in there is I think it's very interesting because if you look over the last 10 years, international stocks have really underperformed the US. And, a lot of our investors, a lot of our portfolios have something called home bias because most of our clients live in the United States. We have sort of an overweight to the US. But historically, stocks have done very well when you've seen this graph below the dashed lines, right? So kind of in the period from 2012 to the present. And they've done not quite as well when you've been buying sort of at the peaks. So think about 1999, think about 2020. And so when you look at these charts, I think I just want to reemphasize that point you made, because it's so important that this may be a moment where international diversification makes a lot of sense in a portfolio. And I think that's one of the points that Goldman was making in some of their recent analysis, which was even though the US market looks expensive, the rest of the world looks relatively fairly priced. And so there could be some more opportunities there. So just because the US has outperformed for the last decade doesn't mean it's going to continue to outperform for the next decade. And I think that's something that we should all be thinking about a little bit. So sorry, I didn't get that.
Well, sorry, Jim, if I could just add one more point to that, I think another interesting aspect of the last several decades, but specifically the last decade, is globalization has occurred at such a rapid rate. If you look at US stocks, if you instead of looking at the domicile of the stock and instead look at like where their revenues are generated from, so how are you getting exposure to the actual economies internationally? I think it's 40% of the S&P 500's revenues are derived internationally and from emerging markets. Yeah. And I think even 50% of the revenues of the top 10 companies come internationally. And vice versa, if you look at internationally domiciled companies, a good portion of their revenue comes back from the US. And so, we spend a lot of time thinking not just about where a stock is listed, what their home country is, but where are they deriving their revenues from? Are we really diversifying our exposure to economies internationally as opposed to just where a stock might be listed?
Great point.
I think that's a pretty good segue to start talking about what's happening on the other side of the world. And I think this chart is fascinating. Unfortunately, it's not entirely current. You can see from the slide it goes through October 8th. For those that were paying attention, the Chinese stock market definitely went on quite a ride coming out of the summer into October. It's since come off that level and has steadied itself. But I just want to dive in a little bit about what's going on, because Aya talked about the valuations in the US, but China is the other side of the story. Valuations are way more attractive. And while it's a little harder to pinpoint the precise valuations due to the kind of skepticism of some of the earnings underlying there, what we do know is that from a market cap perspective, the market cap of China used to be about 40% of the MSCI Emerging Market Index as recently as around 2020. It dropped down to around 24%. It's back up to around 28% today. So it has been significantly fluctuating, and we could see that it moved almost 40% in just a matter of 2 weeks on the heels of some really extraordinary stimulus news that came out of the Chinese government. Some of those details were all about lending facilities, dropping interest rates, lowering mortgage rates for existing homeowners, a variety of other measures that in aggregate had a very profound effect. But the big question was the market's reaction overreaching or beyond the actual impact of the stimulus? And even more recently, there has been additional stimulus talk that even amounts to an even greater percentage of Chinese GDP. I think I read one measure as much as 8% of GDP in the latest measure. So we have seen extraordinary efforts by the Chinese government to push forward to help bolster confidence, because right now China is not meeting its 5% GDP requirement, and that is one mark that's really important to maintain. And so they're trying to boost confidence. They're trying to get out of this deflationary trend that's been persistent for some time. If you look at the PPI, the Producer Price Index in China, it's been negative for years. It's around -4% right now. So they've had a real deflation problem. There's a lot of real estate problems, as you know about, and we're seeing these extraordinary measures come in. And the outcome of that, of course, is extreme volatility. And so while we are looking for opportunities overseas, we always want to be mindful of opportunities across international developed as well as international emerging. We also want to be cognizant of the volatility that comes along with it. But there is some fascinating things happening right now in terms of trying to push this forward, and it does make up a fairly significant portion of the world market.
So, I'll take this slide here on the labor market. I think, Jim touched on some great points in the intro. We continue to think that global monetary policy will be the main driver of market reactions in the near term. And I think the base case that a lot of people are planning for is this soft landing idea. But I do think recession risk remains probably slightly above average, and that's largely due to the labor market, and it could be at an inflection point. I think the Fed is looking at that. Their main measure originally was inflation. That kind of got taken care of. Now they're paying a lot of attention to the labor market, and I think a lot of other market pundits are also looking at the labor market thinking, where are we in this? We've seen some kind of fluctuating numbers, and I think we can look at it in two different ways. I think we are seeing some positive trends in labor growth, driven primarily in the private sector, with services being a big piece of that. We've also seen the breadth of job growth improving over the last couple of months. So it's not just one area that's leading the way, it's across multiple areas. And so that's a positive. We see cyclical employment continuing to grow. So think construction, manufacturing, transportation, retail. And so that's all positive. On the flip side, though, we've seen some creep in unemployment. Last month, we came back down a little bit, but we were on an uptrend. And I think a lot of people are trying to figure out what are the drivers of that. And the good news is it's not coming from the current workforce being laid off. We are not seeing an exaggerated increase in layoffs or corporates kind of taking workforce off the table. What we are seeing, though, is an increase in supply, and that's coming a lot from immigration. We're also seeing it from multiple job holders. And so we have this kind of bifurcation where we're seeing an increase in supply, and maybe that is not quite being absorbed by job growth. But where we do see unemployment slightly ticking up, it's not because corporates are firing or laying off people. So It's something to watch closely. It's something we're keeping a very close eye on that is likely going to be a determinant of other factors, consumer health, et cetera, that could be forward indicators if we're entering a recession. But right now, the labor market looks pretty strong, and some of the forward indicators have not triggered us to believe that they're rolling over quite yet.
I'll take this one. So, again, going back to Doug's point in terms of what's going on in the labor market, we're seeing positive movements in the labor market, but it's not just one economic data point, right? This graph is the Citigroup Economic Surprise Index. So this measures the relative, surprise to the upside or to the downside relative to where consensus expectations were when the data comes out. So, as Doug said, when we got the labor numbers, they were better than expected. We also got better than expected ISM services numbers, better than expected retail sales numbers, better than expected consumer confidence numbers. So that is all showing up in the data points here in this graph. And so we've seen this uptick and this rise in the economic data showing better than expected numbers. And that's, good for the overall economy. We're seeing it in all the areas that we want to see it in. And it's been a positive impact to markets as well.
Aya, if I could take the other side of that argument, I think this chart does a great job of maybe reflecting what many of you out there are feeling. And this is a contentious point, especially as we enter the election period, and a lot of folks have uncertainty on their mind. A lot of folks are just unsure about where inflation is heading, where am I going to find employees, the right type of employees, how much inventory should I be stacking? There's a lot of questions out there. And so this is a really interesting chart from the NFIB, the Small Business Uncertainty Index. It's actually at a historically high level. And if you look at the overall optimism index, it's actually been below the 50-year average for 33 consecutive months. And what that means is that there's just a variety of factors out there that are impacting small business owners that maybe doesn't show up in the other indicators, such as the Citi Economic Surprise Index, which is capturing, larger companies, S&P 500, Fortune 500 type of companies. Small businesses are feeling it. They're not exactly sure about hiring or other capital expenditures and plans. And so I find it really interesting when we take this other perspective. This is impacting investor behavior, investor dynamics, and how people feel in terms of spending and investing outside of what's happening at big companies. So there's certainly other ramifications beyond just what big companies are experiencing from an economic perspective.
Yeah, I think Gary, to the point is, as investors, when we think about markets, we're always looking for these points of tension where there's disagreement, right? So on one hand, we look at valuations; they're very optimistic. On the other hand, we look at small business owners, and they're feeling this level of anxiety. On one hand, the economy appears to be doing very well. On the other hand, right, we have the very people that drive the U.S. economy, small business owners, saying that they don't know what comes next, and so. It's the views on those tensions that generally drive investment decisions. And so that's what we as an investment team talk a lot about as we think about, positioning inside of your portfolio, figuring out sort of where those tensions probabilistically fall, where do things fall out, and who do we think is right? Do we think the market participants are right, or do we think the small business owners are right? Right. And what percentage right are they? Right. So it's not just enough to say who we agree with, but we have to probabilistically weight whether or not that particular view is likely to sort of hold sway in the future. So very interesting to sort of look at these data points and sort of figure out where those tensions are. Doug, I think you might be. Yeah.
Sorry, thanks. I was just saying, I said, what do we do when we see confusion? Well, we look for more data points. And so there's another one right here. And so I think Jim stated early on in this that, the definition of a recession is, or the traditional definition is 2 consecutive quarters of negative GDP growth. But there's other ways to try to be more forward looking. And one of these is the NBER recession indicator. NBER is the National Bureau of Economic Research. It's a think tank that looks at a lot of these economic indicators, and they've put 6 recession indicators together. It has to do with personal income, non-farm payroll, household surveys, consumer spending. And these look pretty good, right? It's an informal measure, but while these aren't hugely positive, they're not negative. And if you look at a rolling month over month of these statistics, nothing's in the red today. We saw that a little earlier this year. There was a few triggers of these that did show red, but we've kind of bounced back towards green or yellow light in many of these indicators. And so while there's pocket of weakness, I think the resiliency of the consumer and the current labor conditions, as we pointed out in a few of the prior slides, is really what's keeping this cycle alive. That being said, as I pointed out before, I do think labor is probably the one to keep the closest eye on, because that's going to have the knock-on effects to the consumer, which is really bolstering the economy today.
I would agree with that, Doug, and I'll just add a few points as it pertains to the future path of interest rates. I mean, we've been talking about this, what seems like forever, right? We finally had that decisive 0.5 percentage point cut in September. So we are now, sitting between 4.75 and 5.0%. And the big question is, what is the pace and magnitude of future cuts? Will the Fed cut by more than the expected 25 basis points, which is largely priced in November? And how many more cuts will we get after that? And if you listen to what the Fed has been talking about for quite some time, they talk about being data dependent. And so if we do have a stronger than expected labor payrolls, what will that mean for the future path of interest rates? And so we can see from this chart, we have roughly 7 more percentage point cuts priced in. That'll get us to around 3% by the middle of 2026. Obviously, that's not guaranteed to happen. If we looked at this chart at the beginning of this year, as you might recall, the market had priced in 6 rate cuts, which seemed pretty extraordinary at the time, and it certainly did not come to fruition. But this can and will change. But the thing that we do expect at this stage is that the Fed is on a path towards cutting rates. So we can expect shorter rates to some extent and degree in the short run, but the magnitude is still unknown. And then the second part of that question is what will happen to rates on the long end? And what we saw a few weeks back is that rates on the long end came down, but recently we've been seeing a little bit of a backup in yields, and a lot of that is speculative. A lot of that might happen to do with where investors are expecting the results of the election to be. Now, I know Aya is going to talk a little bit about the market and elections, but it does seem that market has been pricing in a potential shift in expectations about who wins the election, and it's impacting the expectations for potentially higher growth and higher inflation going out. So if we flip to the next slide, maybe Aya will talk about how the markets have responded or reacted based upon a variety of different election outcomes. Aya?
Sure. Thanks, Gary. So, as Gary mentioned, we're days away from the election. And so depending on who is president, who is what the makeup of Congress is going to potentially change. But however, I'd like everybody to focus on the dark blue lines in these bars. So the blue bars are the range of outcomes depending on who's in the White House and who is in Congress, who has control of Congress. But the dark blue lines are the averages there. And so they're all positive and in double digits. I mean, those are pretty good numbers there to focus on. And so for us, I think, we want to make sure we're pretty optimistic about no matter what the outcome is, even if there is some short-term uncertainty, even if we don't know who is president on Wednesday morning, we will survive all of this. The volatility may be short-lived, and afterwards, markets tend to do well once we have that certainty. We know that a lot of the policies, depending on who gets elected, will change. And I know there's been a lot of attention towards taxes and tariffs and trade policy, but a lot of that will get worked out in terms of the details once we know who's in office.
I will say, I think whether it doesn't really matter which candidate wins with respect to the deficit, because both candidates are making massive promises around spending and tax relief for various portions of the economy. And I think it was Warren Buffett who said, in a democracy, inflation is the natural course, because eventually politicians get to the point where they basically just give things away. And I think both candidates in their speeches have been very aggressive about making promises to the electorate. And I think that if either candidate was to make good on those promises, we probably would see an uptick in inflation. And I think in the last couple of days, the last few weeks, we've actually seen bond yields start to rise because there's a realization that the deficit's likely to grow. That's going to put more pressure on the bond market. So that's another thing to watch out of these elections, which is, it doesn't really matter which candidate wins from a deficit perspective. There are lots of things these candidates disagree about, but at some point the American public is going to have to pay the bill for all the services that we put in place, and it doesn't look like it's going to come with the next administration. And so, what are the consequences of that? And that's something that we should all be thinking about.
Absolutely.
Well, I appreciate everyone joining us. I know this is a time of great uncertainty. I know there are people who feel very strongly about the election one way or the other. And I think, as Aya said, we'll all wake up the next day and we'll be here, and there will probably be some volatility after the election. But that's really not what's going to determine things, especially in the short term for the markets. We're very keyed in right now on looking at what's going to happen with the Federal Reserve and interest rate policy more generally at the November and December Fed meeting. We'll be talking a lot more about that as we come back and talk to you in the months ahead. We're monitoring the strength of the labor market. That's going to give us a clue whether we're going to achieve the soft landing, which, you know, we've had a lot of people claim mission accomplished, and it does look very good where we have inflation coming down without the employment market suffering disproportionately, but we're not there yet. And so the question is, what happens with the labor market? And certainly there will be volatility around the election, as we've discussed, but that volatility, as we've seen, is generally short-lived. And in the end, it's always important for you to remember that the president doesn't actually determine the outcome of the markets. And whether we've had a Republican president or a Democratic president, we've seen markets rise over time. And so don't buy or sell stocks based on where you think this election is going to come out, because you'll probably get it wrong. And most people do. And the right answer is to stay invested over time. As we look at opportunities ahead, we think large caps continue to lead the pack, but as we've mentioned, this might be the time for diversification. There are other parts of the market that look much more attractive than US large caps on a valuation basis. As you know, Aya and Doug pointed out, valuation is a very tough thing to trade off of, because valuation tells you something about long-term performance, but doesn't necessarily tell you anything about short-term performance. And so, as people have reminded me in the past, just because something's cheap doesn't mean it can't get cheaper, right? And so, that said, as we are long-term investors here at Wealth Enhancement, as our clients are long-term investors, it's important to think about this. The other thing is there's opportunities here to lock in higher rates, right? So rates are likely coming down, although as we discussed, there's some risks to that based on what happens with deficits. And so we can start to take advantage of the steepening yield curve. And as always, sort of the most certain type of alpha that one can generate is tax alpha, helping you reduce your tax bill. And when we have volatile environments, there are opportunities to do what's called tax loss harvesting to offset gains that you'll realize in the future. And the ways of doing tax loss harvesting have gotten much more advanced over the last few years. And so talk to your advisor about enhancing the tax loss harvesting in your portfolio, because especially during volatile markets, there's some terrific opportunities. And I think with that, we have time for one or two questions. So Tom, have any of our listeners submitted any questions to us today?
Yeah, we got a few questions here. First one, what's your take on the rapid sector rotation seen in 2024, and how does that look going forward?
That sounds like a question for Aya.
So it's a great question. You know, we have seen a broadening out of markets. Again, the first half of the year was really the Mag 7. A lot of that got a lot of attention for more than just the first half, but last year as well. And we've seen that broadening out, especially as interest rates have come down. And some of the more cyclical interest rate sensitive areas of the market have started to perk back up. And that is a great thing. We want to see broader participation across markets. We don't like to see, concentration in just a few names leading the overall index higher. We'd like to see that broad participation because, again, it's a reflection of the economy doing better as well.
Do you have another question?
Yeah. All right. Who wants to pull out their crystal ball for this one? How long is the stock market going to stay doing so well, and what is the trend for next year?
Doug, do you want to take a stab at that?
My crystal ball is always a little fuzzy, but yeah, I think, it's an interesting question because I think there's two pieces of it, right? How the stock market absorbs news and reacts to it versus how does corporations do on the whole. I think what we've seen so far is corporate earnings continue to look pretty good, margins continue to look very good, and so the expectation is that if corporates continue to do what they're doing, this is a broad statement, but we're talking about broad things. I think the market can continue to perform despite some pockets of valuations that seem stretched. There's a lot of other 490 other companies in the S&P 500 that look much more reasonably valued. And if we see kind of a valuation gap close between maybe those top 10 names and some of the other 490 or 80 out there, I think there's a lot of room for the broader markets to look pretty good. That being said, broader markets, their prices are sensitive to what goes on in the rest of the world. And so we know that, looking forward here, there is a lot of geopolitical tension, whether that be just our, at home here, we have an election coming in a week, or you look overseas, we still have a lot of tension in the Middle East. We still have a war in Ukraine. We still have issues with China and Taiwan. And so there's a lot of things to weigh around just what is the macro economy doing. And so I think from a fundamental perspective, we haven't seen cracks in the system. But I do think that the cracks that could occur might occur quickly. And so it's important for us to continue to monitor those underlying metrics that we've discussed on this call to make sure that we feel that, those forward-looking areas that we can see, continue to maintain, a robust outlook while monitoring for exogenous risk events. And, it's hard to step out of the way of those. We are not here to time those, but if volatility does, rear its head, Jim made a very good point. We'll take advantage of that. It's a great time to maybe lock in some losses, to deploy some cash on the sidelines, or to rotate towards things that might have got more attractive.
Maybe one more question, Tom.
Yeah, I know we kind of touched on this one already, but we got a lot of questions about it. So what are some investment strategies to consider regardless of who wins the election?
Gary, do you want to take that?
Sure. I mean, we are investors for the long run. So investing in a portfolio of high quality assets over the long run that are well diversified, well constructed, and have risk characteristics that offset one another, with emphasis on, traits that are built to survive over the long run, are really, really important. So high quality is certainly a focus there. You certainly want to make sure that you're not going too far in on any specific thematic strategy, trying to chase returns such as Mag 7, NVIDIA, or any of these other high flyers. Don't necessarily focus too much on any of those past winners, but think about diversification from a broader perspective. So there's a lot of different strategies that we can also use that to complement traditional equities and fixed income, such as some low correlated assets to help mitigate volatility. Because the one thing I would add to what Doug talked about in terms of the crystal ball forecast, the one thing that I'm worried about is inflation. If inflation does come back because of some of those factors that Jim talked about, that could, of course, change the projection of where the Fed is going, and that could alter a lot of different things. So you want to make sure you have elements in your portfolio that are there to offset the impacts of inflation, to offset the impacts of higher rates, and that's just really having a well-constructed portfolio. So high-quality portfolio designed for the long run should prevail in all weathers.
Thanks, Gary. I think that's well said. Again, don't try to time the markets. Timing the markets has generally not been a successful strategy. The successful strategy is staying in markets over time. And so I know, again, there's a lot of anxiety about the election, but do not use that anxiety to make decisions about your financial future, because in the end, it will actually end up putting the financial future at some risk. So stay the course, get through the anxiety, talk to your advisor, and let's take advantage of volatility when it rears its head. And so with that, thank you for listening, and we look forward to talking to you again next time. Thank you.